Good afternoon, ladies and gentlemen. Welcome to IPE. I'm Brendan Mason for IPE. Today we're looking at over-the-counter interest rate derivatives, how and where pension funds clear them. Is centrally cleared derivatives a blessing in disguise? If you're responsible for liquidity management at any pension plan, then this is the webcast for you. Cash flow management, securities, more than ever. These tough times, market conditions are not yielding very much. Plenty of mature DB schemes don't have the cushion of hefty contributions coming in to pay their liabilities on time. Now we've got top-level representatives from the ecosystem here to discuss all this, what's heading for your inbox in terms of regulation and best practice. I would just like to tell you this is Chatham House rules, okay? So please do not quote anything you hear over the next 60 minutes without permission from the speakers. I'm sure you will get permission from them, but please check first. It's a live webcast, so we always welcome your questions. Please put your name and the organization you represent. That's very important to us at IPE. And we'll probably pose your questions all the time because it's going to be conversational. Let me introduce the speakers who are going to be explaining more. Let's start with Matthias Graulich, board member responsible for strategy at Eurex. Hi, Matthias. Welcome to IPE.
Hi, Brandon. Nice to be here today.
Now, Eurex is right in the middle of the derivatives trading ecosystem. Matthias, you're a central clearing party. CCP, that's an acronym people will hear a lot in the next 60 minutes. The European Commission wants more interest rate derivatives cleared centrally. Good news for everyone, hopefully. Certainly good news for Eurex, right?
Well, yes, of course, it's good news for Eurex. And I mean, this process has been in place for quite a while, with now getting a new twist on the pension fund getting into this clearing obligation. But I think, while it's good for Eurex, it's, I think, good for the overall market. And that is the important thing, because one of the lessons learned from the great financial crisis back in 2008 was that the market is not resilient enough. And what we have seen with more and more adoption on central clearing is clearly that the market got more resilient and more robust during the crisis we have seen over the last couple of years since 2008. And CCP really effectively reduces risk and takes out risk of the market. And while we see more interest rate swaps moving into clearing, I think the discussion most recently has gotten a slightly different twist, which raised the question, at which CCP are certain products cleared? And here, I think the question comes into play if we talk about systemically relevant products like the Euro swaps or the Euro credit default swaps, at what CCP are they cleared, and what are the interests, for example, of the central banks and the regulators in these products? But we're coming back to that topic.
Yeah, you're racing ahead. You're racing ahead, Matthias. This is that's the meat of the topic. Let's present the other panelists first, and then we'll get back to this issue you raise. It's super profound, actually, more so than ever. Let me introduce, unfortunately, you can't see him on screen, everybody, but he's dialing in. Jan-Mark van Wil, Head of Treasury and Trading, APG, Asset Management in the Netherlands. I'd say probably the largest pure play pension fund manager in Europe. Hi, Jan-Mark. Welcome to IPE.
Thanks, Brandon. And it's Jan-Mark van Mil with an M instead of a W, but that doesn't matter.
Thank you for checking.
Happy
That's
to be
journalist.
here.
Yeah, we do make mistakes. I'm sorry.
That doesn't matter.
Just to give the folk viewing a sense of the importance of liquidity management, Jan-Mark, APG approximately 550 billion euro in total, might have gone down this year. About 15 to 25 billion is in the treasury liquidity buffer. Yeah. So it's a sizable amount within total operations there, right?
Definitely. And if you relate how do we come from the 550 billion into the 25 billion of liquidity buffer? In between is a massive hedging exercise, both in rates and currencies. that have a constant need for collateral and cash to maintain those derivative positions. And that is exactly what we in the treasury and trading do. We are trading those derivatives and we are managing the risks of that in the treasury.
Yeah.
So it's a big operation.
It's profound, and we're very grateful for having you on the show. Apologies for getting the family name wrong. We already have a central clearing party, folks. We have a sizable pensions asset manager. Next up, we've got a regulator. Yeah, Anna-Rita Tonet, Policy Officer in the Directorate General for Financial Stability, Financial Services and Capital Markets Union at the European Commission. Anna-Rita, delighted you can join us on IPE.
Thank you very much, and good afternoon, everybody. I'm glad to be here with you today.
Let's just confirm what people have been saying. The Commission wants more entities like APG, pension owners, to do its OTC derivatives trades via the likes of Eurex, central clearinghouses. That's coming, right?
Yes, indeed. As you said, that's coming. Under the European Market Infrastructure Regulation, EMIR, the central clearing obligation is going to apply to pension scheme arrangements in June 2023 at the latest. As you know, the Commission has proposed a delegated regulation in June to extend the current exemption for 1 year until June 2023. This is now under the scrutiny of the Parliament and the Council as the usual procedure, and this is the last extension possible under the legislation. So yeah, that's it.
Yeah. June 2023 is the final deadline. All pension schemes thereafter need to be cognizant of the clearing. Could have introduced our final panelist first in a way. It's Matti Lepala, Secretary General of Pensions Europe, because Pensions Europe's the representative of all national pension fund associations in the EU. Hey, Matti, welcome to IPE.
Hi, Brandon, and good afternoon, everyone. It's a pleasure to be here, but I only wish we represented all pension fund associations. We do represent 25 national pension fund associations, so we do represent a big part of the funded pension market in Europe.
Yeah, well, 25 isn't bad. I mean, that's a strong majority.
Yes, and we have the biggest pension fund countries in Europe, and also very happy to have, for example, for insurance Sweden, where in Sweden, big pension insurance companies are transforming into pension funds under the European Pension Fund Directive, and they are our members. So we do represent a big part of the European funded pensions market.
Super. So glad for you to have you on the show. We're covering all bases here, which is great. Let me continue with you, Matti. We've heard it from Matthias already, I think from Anna-Rita too. The drive towards central clearing is all rooted in improving the resilience of the financial system, born out of the global financial crisis. That's a good thing, right?
Yeah, I mean, it's important to remember the background, that it was in the G20 Pittsburgh meeting in 2009 when this was, very quickly negotiated and approved, that there's mandatory clearing, and to improve transparency and mitigate risks, and central clearing via central counterparties is an important tool to address systemic risks and of course to prevent future crises and the associated high costs for the public in the end. So we are in this long journey since 2008, 2009, and when we then adopted the European legislation, it was clear that then Commissioner Jonathan Hill from the UK said that this, we're now with this piece of legislation, it's an important step to implement our G20 commitments. So this is a global regulatory development.
Yeah. Okay. Would you say that central clearing improves security for pension scheme members, Matti?
Yes, it does. But however, of course, clearing is not risk-free either, and there's a lot of debate about bilateral versus central clearing and what are the pros and cons. So it's not clear cut. So there are risks, and central clearing can also result in loss mutualization in certain extreme situations, and those, of course, going against pension funds' interest in protecting their members and beneficiaries in the end.
Yeah. We're now getting into the heart of it. It's great. We've got this regulation coming. It's been pending, I suppose. Its application has been pending for pension schemes. Pensions Europe has spent a lot of time discussing this. Lots of useful papers written, not just by you, but Eurex and other interested parties. APG has been very vocal on it. The audience, you can see, folks, some useful documents by Eurex that are attachments to this webcast. So you can, if you want to catch up, get into the meat of the discussion, you can download those. I wouldn't do it until after this webcast's over, because you've got the experts on the line with you. Let's talk, Matti. You give me an example of an extreme situation which could work against pension schemes. This is the risk. I'm sure it's very rare, but why don't you spell it out for us?
Yeah, I mean, big risks, big credit losses, for example, or any undiversifiable systemic risks, then of course, then big players like central counterparties with central clearing, they can also become systemically risky. So undiversifiable systemic risks are difficult to diversify from the system. So whether you opt for a central counterparty or not, you still have these risks.
Yeah. I mean, of course, it's interesting if we think back to 2009 and what people were grappling with. It was one of those, it succeeded, one of those moments in time where everything seems to be correlated. There seems nowhere to hide. It didn't seem to be diversifiable. Liquidity, confidence shrank or almost disappeared. Indeed. So it could happen again. And it's interesting how Matthias was saying that in the following 12 years, the world has become a lot more secure. I'll let Matthias come in a minute, but what I want to ask you, Matti, at the top of the show is, given this risk, as you say, a rare event, but possible, what's Pension Europe's policy been? How do you address the challenges for pension funds with...
This far, we've of course tried to figure out what would be the best solution, and we've lobbied for the exemption and extension of the exemption, which now comes to an end after 1 year, and that's where we go to central clearing, and so we need to have a permanent solution. And so we've thought with many of our members and with many asset managers as well, like what would be a good solution, and issues that you mentioned, liquidity. And of course, for pension funds, the fact that if you have to use cash for the margin requirements, that poses risks. So we've argued that pension funds are low risk as counterparty, and we've argued about the problems of having too much cash, and then of course the problems that everybody is faced with, and pension funds as well, in stressed market situations. So trying to come up out of this with then a solution where we think that the central counterparties could then help with the situation if then they could provide central bank liquidity to pension scheme arrangements in stress situations. So that's the idea that we have been now proposing to the European Commission.
Yeah, you want to involve central banks, yeah, as an added layer of protection.
Yeah, I think that's the ultimate institution here that can provide this. I think anybody else will be faced in an extreme market stress situation with problems that we've seen in the past. So I think that's the way of thinking that we have, and that's the proposal that we are supporting now.
Yeah. I'd be very interested to know how many of the IPE viewers agree with that. We'll get into more details as the webcast unfolds, but on the outside, it makes sense that if you can reduce the amount of cash you need to hold to cover your positions, then that would be helpful if the central bank's willing to play. Matthias, let me come back to you, because obviously Eurex very cognizant of this. It's in some of the papers I mentioned that are attached to this webcast for the viewers to download. Just clarify here maybe what Eurex has done to address these challenges and risks Matty's mentioned. Can you start actually before anything else by talking about this big risk that Matty mentioned of loss of mutualization? It might be useful for the audience to understand the nature of a CCP and what mutualization means here.
Yeah, no, I'm happy to address that first. And I agree that also a CCP is not risk-free, right? But a CCP is set up with the profession to manage risks, other than, for example, a bank who is a risk taker. And we are just a neutral risk manager, and we have lines of defense which cover a greater confidence level than 99.9% of all events which have been seen. And if you look then down the lines of the further lines of defense, I think we are well positioned to cover even more events than what the face value says. So I think, and if you then always compare it with the bilateral world, I think then do a one-to-one comparison, I think you are much, much better off with the CCP, because the CCP, for example, prevents the knock-on effects, the domino effects we have seen back in the crisis in this many network, whereas here we have a much leaner, a much more transparent network. And that is, I think, a major benefit. And the loss mutualization at the end does not, well, there is one possibility if we talk about a resolution tool, which is variation margin gains haircutting, which could affect clients like pension funds. But this is really a resolution tool and is on the back end of the waterfall. And all steps before, losses would not mutualize with non-clearing members or with members who are in a hybrid structure, which I'm alluding to in a second, where always the clearing bank would take up the mutualization part. Let me come to your second, or actually your first question on what the CCP has done. And now looking and reflecting shortly on the issue Matti was alluding to on the cash variation margin. We have, I have been personally in the expert group of the EU Commission for the last many years to discuss solutions, and the central bank aspect will come back at the back end, but we felt that we want to develop something in a market-driven way, a market solution. And what we came up with in coordination with other market participants is a solution where we said, cleared repo markets are really very robust and resilient source of liquidity, in particular in times of stress. So what we have seen in all crisis situations, inflow into cleared repo, outflow of bilateral repo. Now, the question for us then was, how do we get the pension funds into the cleared repo environment? Because the traditional client clearing models would not work at all. They would be economically completely unviable. And so we had to get some innovation into the game. And what we came up with was a hybrid access model. The pension fund directly faces off from a credit risk with the CCP, but would not have to shoulder all the obligations of a traditional clearing member, like default management obligations, default fund contributions. These would be covered by the clearing agent or clearing broker. And via that option, we found a way to get, in a very capital efficient way, the pension funds access to the cleared repo environment. The second aspect we tackled with this was a kind of, if you look at the interest rate swap market, which is the kind of clearing space where I always heard from the pension funds, well, we are concerned only 10, 15 clearing brokers, are they able to shoulder our large directional exposures? So there is a big concentration concern. And we said, look, this model at the same time addresses your clearing broker concentration concern because you face the credit of the CCP, and the clearing broker role is not credit intermediation, but facilitation. And that, of course, makes the whole aspect of the reliance on the clearing broker from a credit perspective much less. That is what we have done in the last couple of years to address the problem.
Okay, let me turn back to the policymaker, Anna-Rita. I'm perhaps going back a step. Just to clarify, the European Commission, it's got resilience of financial services in mind when setting policy. Have we got the story right thus far, what you've heard?
Yes, I mean that's right. I mean, we have indeed financial stability in mind when we set our policy lines, and this is where also EMIR fits. No, it is in this context, as also the previous speakers have mentioned. I mean, EMIR was a key piece of legislation adopted in the wake of the great financial crisis to mitigate the counterparty credit risk, which is the typical risk which characterizes derivative transactions. And this is done through a central clearing obligation, which was imposed as an international standard and which is now adopted in all the major jurisdictions around the world. So EMIR also enhances the transparency of these derivative transactions through a whole system of reporting. So it's really there to tackle these aspects, which were, you know, the lessons that we drew from the financial crisis at the time. Now, I mean, that is also the reason why EMIR includes in its scope a very broad range of counterparties. So under the clearing obligation, there are both financial and non-financial counterparties, because I mean, the aim is to capture all those that are active in derivatives above certain thresholds. And I mean, that is why for the pension scheme arrangements as well, the idea was always that they should get into the system, and also the exemption should be of a temporary nature. Now, I mean, after 10 years of EMIR, what can we say? Did we get the story right? I mean, I think that we can say that central clearing is, yes, an international paradigm, and on which the stability of our financial markets rely and will continue to rely. So, I mean, I think, yeah, that's the kind of conclusion that we can draw.
Can I check? Yeah, I mean, let's just talk a little bit about the pension fund exemption. What you said just there, it was as if you maybe thought that they would voluntarily come in. Is that right? And they haven't done enough of that in the last decade. So you said, okay, guys, it has to be obligatory. Is that a fair interpretation? No,
I think that at the time when EMIR was adopted in 2012, it was considered that for pension funds, I mean, given their type of business and characteristics, a central clearing obligation could affect in a disproportionate manner the retirement incomes of pensioners. So that was the rationale. And that is why this temporary exemption was included. But as I said, it was a temporary thing with a view to having market participants work towards, finding solutions. Yeah. So that is why the time was allowed for that to develop, basically. And I think it's also, I mean, useful to note that when EMIR was revised in 2019, so the recent revision, EMIR refit, so-called, the co-legislators, they decided to set an end to this exemption, and also they required a lot of reporting and monitoring of all this process from both ESMA and the Commission. So, I mean, we issued reports, and also ESMA analyzed and had a public consultation, etc., to assess the progress made towards finding solutions and moving towards central clearing. The idea was really to move there, basically, and yes, I mean, what we have seen, I mean, also through an expert group, which was mentioned also by Matthias, I think, that we managed in the Commission, and which was also required by the law, with all the relevant stakeholders. We facilitated this kind of dialogue and, monitored the efforts made towards central clearing. And indeed, what we saw is that indeed on the side of CCPs, there was an effort, as Matthias was recalling, to set up models which would facilitate access to repo and to central clearing by pension funds and buy side entities. And on the side of pension funds, we also saw that they have started, as you said, clearing voluntarily as well, at least a portion of their portfolio of derivatives. And they have also, increased their operational preparedness. This is what we understand also from the analysis done by ESMA, etc. So I think that's where we are, and that's the additional year that now is to come. Should allow to finalize all the relevant preparation, also in terms of liquidity management and all those aspects that need to be addressed.
Yeah, and we'll get into, maybe we'll get some insights, especially from Jan-Mark Vermeulen right now, about how to prepare. Obviously, APG is one of those that's already voluntarily taken the steps on behalf of its pension scheme clients. For those listening who are not yet up to speed and realise they've got less than a year to be ready, why don't you tell us about the APG journey? That might be very instructive for other pension scheme representatives listening today.
Sure, Brendan. Yeah, that journey has been a long journey for more than 10 years now, I would say, because we've been, on the one hand, very active in the lobby, pleading for the pension fund exemption, because we see central clearing as a good thing to the market, but there are some risks and topics that need to be covered to have it function fully in the best interest of the pension funds. So the journey was on lobbying and trying to get the exemption there, but the other side of the journey was with the same speed getting your clearing infrastructure up and running, because an exemption is an exemption and it will end at some time. And now in 2023, it is ending, but we have been building out our clearing infrastructure, predominantly, of course, in the rates clearing business, for the last few years, and already voluntarily utilizing that clearing infrastructure. There is multiple clearers at multiple clearing houses, and also the risks of the liquidity here. That is why we have always been pushing against that clearer. The liquidity risk needs to be covered also, and that is why we have introduced our repo infrastructure into the Treasury toolkit to manage those risks. So a bit schizophrenic, holding it back on the one hand, and on the other hand, building very hard on that infrastructure, because it is vital to a pension fund to have that. Yeah.
It just sounds like very sensible organizational strategy. Some friction, Jan-Mark, facing both ways, but very sensible risk management, I would say. And can I just ask, now everything is operationally ready, you're clearing, you've got that repo clearing infrastructure in place. APG, no more construction necessary for you, just operational management.
Yeah, but just operational management makes it sound as a simple exercise.
No,
I think that we are also learning on how to utilize and risk manage the different clearing houses versus each other, and the various clearers that we utilize versus each other, and also how to risk manage the liquidity management that goes hand in hand with a large cleared position. And we are, of course, operationally ready, and we were always in the bilateral world exchanging collateral and cash on the back of our derivative positioning.
Yeah.
But I think that the prudence, the speed, and the sophistication that now comes with the clearing model adds to that operational layer, and makes it also very interesting, to be honest.
Yeah. I understand that. I mean, I'm sure the audience will want to hear more. So maybe if you've got any questions for Jan-Mark van Mil, he's there doing this, and I'm glad you're on the webcast, Jan-Mark, because I think you might be the person people want to know more from in terms of basically how can I learn. You as you say, it's transformational for you internally. I'm sure others will want to hear more. Can I say, actually, I mean, is there this could be the wrong type of question, but do you think in time with practice you'll be able to reduce your costs because of familiarity? Or would you say to me, no, Brenda, we've got loads of experience. We're not going to be able to improve our cost efficiency in years to come? I'm just thinking back to variation margins and pension funds not wanting too much tied up there, wanting to put their money to better use.
Yeah. So the big discussion at the beginning of this whole clearing discussions was always, you need to post your cash, your VM in cash, and for that you need to maintain your buffers. Mm-hmm. Cash that you need to hold cannot be put to work in capital markets. Hence, you have a drag on your investment portfolio, a drag on your cash, and that is a very costly exercise. Now, the other thing of a pension fund is that where we are invested, equities, but also bonds, and especially the government bonds that we hold, have a fantastic collateral value. So the puzzle that we need to solve and where we need to look at is how can we utilize that collateral value in our bond portfolios optimally and still operate it in the cleared environment. And that all boils down to transformation from bonds into cash and vice versa in a very speedy and effective manner. I guess with the current infrastructure and the toolkit that is available to asset managers and pension funds in the treasuries, it has become less costly in terms of holding those buffers, because you don't need to hold as much as we assumed from the start, because the transformation is there. The only difficulty is we still need to rely on the repo markets, both cleared and bilateral, for that transformation function, and that is why we always plead for instance, central banks to be active in that part of the market, also from a financial stability perspective, because if the repo markets don't function, either in bilateral or cleared, we still end up with a big issue of not being able to transform our government bonds, high solvency, solvent material, into cash liquidity, and that is the essence.
Yeah, brilliant. Thank you. That's super clear, Jan-Mark. That's very, very valuable from you. And if I can make a little joke, it's nice that we still have a use for government bonds in 2022, because they haven't been returning very much. There we are. They've got collateral usage. Thanks very much for that. Let me turn to Matti now, because one of the reasons why Jan-Mark's on the APG, biggest pure play pension manager in Europe, most of the people listening, they won't have 500 billion euros under management. Some of them won't have 500 million euros under management. That is natural. There's a long tail of pension plans in Europe. Lots of them won't be exempt. They will be caught by these regs. what's the message for them? Maybe you could even mention if there are any that actually are underneath the regulations. But has Pensions Europe any information and any messages, any resources for these smaller schemes?
Yeah, not an easy question. Indeed, the larger pension funds are operationally ready and to clear, and so that they have clearing arrangements in place and that they clear voluntarily also. So like APG and the other big Dutch asset managers, service providers for big Dutch pension funds, so PTGM and MN, and as IPE, you have already, you have covered in your articles in the past, so that we know. But then smaller pension funds, some of them or many of them, we really don't know. They haven't started, but of course they, in 1 year or less than 1 year's time, they need to start clearing, and they must prepare themselves for it. In our internal work, we have really worked mainly with the big pension funds and their representatives, because they've been most concerned, and then their asset managers like APG and some other big asset managers. So the smaller ones also in discussing this issue in the past have not been as active, but of course now they need to get involved and they need to have solutions in place.
Yeah. Actually, Anna-Rita, I'll ask you. You may be able to tell us, what are the consequences for pension schemes that are not compliant from, well, this time next year?
Well, they should be. That's why they have 1 year further to get there. So actually, of course, this exemption should come to an end. It was a temporary thing. I understand that bigger pension funds may be more ready for that, but the idea of giving an additional year for this exemption was exactly for precisely to allow everybody to get there. So yes, that would be my answer. So
there's no fixed fee, because presumably it's done on a member state by member state basis. So we can't say if they miss that deadline, they'll have a penalty of 100,000 euros. We don't know what the penalties are going to be.
Yeah, there will be penalties, but I think they should talk to their supervisors as well to have a better understanding of these issues, I guess.
Okay. Matthias, let me turn to you, because the real question, actually, Matti just mentioned it at the end. He spoke about the asset managers. And APG, strictly speaking, is an asset manager. Its clients are pension schemes. I would have thought that it's actually asset managers that have been doing the heavy lifting and will do the heavy lifting in terms of compliance in the next 12 months. Is that what Eurex finds?
Yes, definitely, I would agree. And there is a lot of discussions about proportionality and the smaller funds and whether they should be forced into clearing and so on. But the question I ask myself is, how many funds are managing themselves, right? We have the specialized pension managers like APG, PGGM, and so on. And we have then smaller pension funds which are managed by really large asset managers like, for example, BlackRock. And I think all these large asset managers have gone a long way to get ready for central clearing over the last couple of years. And many of their funds are already subject to the clearing obligation, right? And based on what I've seen and heard is that if an asset manager is ready for Fund A, there is not much to do to be ready for Fund B, right? And this is why I cannot really see that there are still a lot of folks out there who are not well prepared, who are not under an umbrella of a central clearing regime. I think the other element, which we discuss in a minute, comes in what is the preparedness of clearing within the EU rather than outside the EU. But that's a topic we'll be coming back in a second. What I'm struggling still, the pension funds have argued a long time for the issue around variation margin, and we developed models to get them access to the cleared repo markets. And we see a number of pension funds now going down that route and finding their access to the cleared repo markets. But I was expecting now 1 year ahead of the obligation kicking in the context of rising interest rates, that more people would want to have that access. And that is something I'm still trying also for myself to figure out, why the demand is not kind of massively more than what we currently see, which is a good demand.
Okay, that's interesting. Well, look, you know what I'm going to do here is I'm going to jump here to an email address. And if you want to answer that query for Matthias Karlich, please contact sales, but you can deal with sales. They're nice people. Fixedincome.sales@eurex.com. You'll explain where you are on the journey to getting your derivatives centrally cleared as necessary. We're not doing down bilateral trading, folks. But Matthias Graulich and colleagues at Eurex would be very welcome to take that call. Whilst I'll leave this email up for a bit longer, and we'll come back to it at the end. Let me ask you, Jan-Mark, because Matthias has alluded to the choice. There is a choice of CCPs. Talk to us about how APG selects a CCP and for what.
Yeah, Brennan, I was out of the call for a bit, so I don't know what Matthias exactly alluded to, but free format, I can answer that question, and then hopefully I'm giving the right answer.
Yeah.
So let's take it from there. Yeah, how we select the clearinghouse, that was the question.
Yeah, what characteristics make for a good clearinghouse?
First of all, at the beginning, Matthias already started. It is their job to risk manage. So we need to understand the risk management, the default waterfall, the mechanisms that are in place in case of an event happening. That is very, very important to us to understand that. Also, because in the future, when we have a large part of our derivative books in a clearinghouse, you want to be able to understand what the steps and the procedures are if something happens, and that you not have to rely on your clearing bank or just second guessing of what will happen. And we've all seen that in the Lehman situation. It took quite some time to actually figure out what is going on here. So you need to understand the procedures, the routines of the clearinghouse.
I've lost you, Jan-Mark. Let's see if Jan-Mark can get on again, which was great. It might be difficult for you to respond. Matthias, do your best. Respond to what Jan-Mark has said thus far. Because, of course, we should say it's on IPE, folks. It's publicly announced. APG said, it was using Eurex to clear its repos in May. So there is a relationship there. We should have said that at the top of the show. You respond, Matthias.
Yeah, well, I mean, and alluding back to what we see with the take up, and there is one thing. I mean, Jan-Mark alluded to the understanding of the credit and how the margining is done and these type of things. So one feature we have at Eurex, for example, is we have end clients. So Jan-Mark, for example, was on our independent risk management committee, where we have dealers and buy-side firms represented to discuss risk management practices of the CCP. And that gives, of course, trust if that is transparent and well managed by the CCP. There's one thing which at the point of time is kind of lacking a bit, which is the number of clearing agents offering these type of services as a facilitator. And while we have a few, and I mean Jan-Mark and a few others have already access via these firms. If you speak to the clearing banks, they say, well, I would offer the service if there was demand for it. And then you speak to the pension managers who say, well, if you know, Matthias, there are only 2 offering it, and it's a bit few. If I had 3, 4, then that would be much better. And then you're settled in this chicken and egg situation. So, and my ask to everyone kind of on the call, if you think that these solutions help in preparing and addressing all the requirements under the upcoming clearing obligation, please approach your clearing broker and ask for the solutions. And I think then we will very quickly see more clearing brokers going down that route. I mean, we have 3 which are live. We have 2 more who are coming into the game later in the year. But please reach out to us or to your clearing broker directly to discuss that. And then I think we can unfold this or unlock this chicken and egg situation we are still facing to some degree.
So I was on mute myself. Yeah.
Brandon, yeah. I'm back. So I'm back in the call.
Super. Did you hear Matthias's last remarks, Jan-Mark?
About the chicken and the egg.
And what preceded it? Yeah. What goes before the chicken and the egg?
No, I didn't follow that one.
Okay, well, stay with us, Jan-Mark, because this is getting interesting, and also we're starting to get some good questions from the audience. So the panelists can look at some of those prioritized questions. I'm not sure we'll do commodity trading. We may do, or we may pass. Let's revert to choices. I want to tackle the geographical thing. This is connected, Matthias, with what you've said thus far. I want to cover this off, though, in the remaining 15 minutes. Anna-Rita, you know, the Commission desires pension funds located in the EU to clear their interest rate derivative trades in the EU. Is that correct?
Yeah, I hope I heard rightly, because I'm also having some connection problems. But yeah, I mean, I think you were referring to the clearing strategy that we have developed and we are working on. Indeed, I mean, we, as you know, I mean, we intend to, in the context of this clearing strategy, we intend to enhance the attractiveness of clearing in the EU and at EU CCPs, and also improve the supervisory settings. And in this context, I mean, we think that this kind of strategy can offer also to pension funds more opportunities and better opportunities for their clearing choices. And also, you know, of course, they may take this into account when they make their clearing decisions. So we think that this strategy could encourage actually pension funds to clear in the EU. Yes, we think it could be a positive development also for them.
Okay. Now, before I bring in Matthias, who's got lots to say on this, we've had a question. What does Anna-Rita think of last week's announcement that ICE, I think it's ICE Europe, are going to stop trading March 31st? Follow-on question, is she comfortable that it may mean most European OTC credit default swap clearing will go to the US? That's from the audience, Anna-Rita. You're on mute, Anna-Rita.
Yeah, sorry. No, I think I take note, and it's a market development. Of course, I have also understood that, and it's a market development. I'm not going to comment on this market. I mean, yeah, these are market decisions, no? So I'm not going to comment on that.
Yeah, I mean, I'll let you experts tease out for me whether CDS is particularly CCP was strong in them or whatever. But it's just a fair point, I think. And Matthias, I'll bring in you in next. That you're talking about pension funds, saying there's a bit of a thinness, a lack of breadth in choice. And here we've got this announcement that you've got someone going out of the market. If you want to stress the difference between CDSs and other elements, other fixed income derivatives, by all means do. I'll hand over to you.
Yeah, I mean, we're not doing credit default swaps, but alluding briefly on that point, I mean, the ESMA report back in December was speaking about the problematic of a product being systemically relevant and not a CCP systemically relevant per se. Now, if this product moves into US, this product stays systemically relevant to the EU and kind of would trigger the same discussions we have now in regards to UK CCPs, in regards to this in US CCP, because the product is what matters. And I think there is a viable alternative, which is also growing in market share to CDS. So I think people are free and probably would do good to go into the EU direction, and in order to make sure that there are no more draconic measures by the regulators to, at the end, perhaps being in a position to force EU-based market participants to do their business within the EU. I think currently we are still in a situation where market-driven solutions are at the forefront of achieving the goal, right? And I think if we manage until 2025 a rebalancing of the overall picture from, say, currently 80-20 to 50-50, 60-40, 40-60, then I think the market has now the chance to achieve that in a market-driven way. And if we achieve that rebalancing in that 3-year period by doing more business within the EU, I think these products and the rest of the portion of the product sitting outside the EU is then of less systemic concern, probably to the EU Commission, to ESMA and the ECB, that people could feel comfortable to say, you know what, under these circumstances, with this rebalancing having taken place, we feel comfortable to grant equivalence to the CCPs where this business sit primarily today. And then I think we have really achieved the ultimately best outcome. We have no enforcement mechanism in place, but we have achieved a regulatory objective in a market-driven way. And that would be, I think, the absolutely ideal outcome. And I think pension funds really can contribute a lot to that rebalancing because of the kind of nature of their portfolio with long-dated receiver swaps, which are kind of the natural opposite of what banks usually hold on the payer side.
Yeah, I mean, you mentioned 80-20 to 50-50, and you used that word ideal. It would certainly suit Eurex. I can see reasons for it, but at the moment, a lot of people are saying that, you know, London is the center for it. It's now outside of the EU, we should say. No one in the extant EU voted for that. That was a UK decision, but it means we've got this problem that we've got these risks, and they're lying outside the jurisdiction of EU institutions. So that's what we've got to underline 3 times. Let me turn to Matti and ask, from Pensions Europe point of view, do you see that as a big risk? Do you agree that, well, with Anna-Rita and Matthias, that maybe if we got to 50-50 in 3 years, that would be good?
Mm-hmm. We're in favor of market-driven solutions. So if and when good services are provided, then that should be the reason for pension funds to decide where they clear. And of course, this far, most of the clearing has been done in the UK, and of course now we have the equivalence in place for a few years. I think the main concern, the biggest concern for pension funds is to switch to clear only in the EU CCPs has been cost related to switching exposures and transition risks, and then another issue that we have heard from our members is the fact that some pension funds have been worried about whether there is limited liquidity in the market for interest rate swaps in small currencies, so other currencies denominated derivatives outside the UK. So if and when these types of issues are solved and the services improve and the market improves in Europe, I think that then should lead to a more balanced situation. So we are looking for good solutions and good services for pension funds to clear. Market driven is what should be, not political.
Yeah. Although you do want the central banks to come in.
Yeah, that's. I think Jan-Mark really already explained well what we're asking here. To come up with a permanent solution is that then in a time of stress, then pension funds could convert high quality government bonds into cash and then use the central bank liquidity for this.
Yeah.
And that's of course, that's within the European framework, a solution that could work.
Actually, I mean, to complete that argument, there's lots of good questions that I'll try to get to before we run out of time. But I mean, Anna-Rita, can ask you that proposal from Pensions Europe, APG is amongst those who support it. Yeah, Mark said as much on this webcast. Is there any possibility from the European Commission's perspective that the central banks could get involved as Pensions Europe wishes?
Well, I mean, of course, we are aware of this debate around the central bank, role, etc. I mean, you know very well that this is not. I mean, this is in the remit of central banks. No, I mean, these decisions ultimately are in their competence. I think that on our side, what we have done over the last years is to try to bring all the relevant stakeholders around the table through the working group that we have set up on this issue of pension funds central clearing. And around the table there were representatives of pension funds, of CCPs, and also of central banks, of course. And so we have tried to facilitate the dialogue there and the mutual understanding of the different views and stances. And I think this has, of course, facilitated mutual understanding of the needs and of the positions. And I think this will continue, I guess, this dialogue. And I mean, that's what I can say, because, yes, indeed, this is really under the central bank remit in the end. So,
yeah. No, it wasn't. I know that you don't. They don't answer to you. It was just your sense of as you said, you have all the relevant stakeholders involved. Whether your sense was that central banks want to do this, they want to be a part of the system in the way that Pensions Europe wishes.
Well, I mean, central banks have engaged in this dialogue, and I guess they are engaging as well. They are continuing not to engage, but yes, I don't have any definitive answer to that because, this is really in their competence, and I don't have a definitive answer to this. So.
Yeah. Let me just quickly ask Matti or Matthias Mark exactly the same question. We don't have a central bank represented here today, but what's your sense of their appetite for participating. Matti first, as you wish.
I don't have a clear answer at the moment, so I'll let the others to respond if they can.
Matthias?
Well, I guess the ECB clearly said that they would be reluctant to provide direct liquidity to pension funds that would not fit the framework and their policy. I think there are ways how it could be achieved to provide that backstop liquidity in an indirect way. For example, if the central bank would join the cleared repo environment, provide liquidity to the bank would turn around, provide it to the asset manager. For the bank, it would be extremely balance sheet light, such a transaction, because they could net both legs. I think there are ways how it could be achieved. And for me, the most important thing, because I think from a pension fund's perspective, the cleared repo markets and the bilateral repo markets will get them a long way into market stress situations. I'm looking more from a market attractiveness perspective at the engagement of the central bank, because if the central bank would do that and provide this backstop liquidity capability within the EU environment, it suddenly would be much more attractive for the pension fund, absent of any obligation to clear in the EU, clear more business in the EU rather than outside the EU, because only within the EU, this kind of backstop liquidity possibility would be available. And I think that would be quite neat, and we're all for it. We're trying our angle to help and support that this gets sufficient support. I think it's really about making the European environment more attractive, and that is one aspect to it. I think we're running out of time.
We are, but there's a few good questions I want to get through. And one very quickly, again, for Anna-Rita, please. Are the clearing thresholds being removed? So we go to June 2023. This discussion seemed to indicate all pension plans must make the transition to central clearings. The question is, we thought only those above one of the clearing thresholds should have the obligation to clear derivatives. What's your response?
I'm not aware that the clearing thresholds are going to be abolished. So, I mean, you can check them. Those there is a delegated regulation with the clearing thresholds, and you can see that they are there. And I'm not aware that they are going to be taken out.
Yeah, I think that it might be my fault as the moderator. I didn't put in the caveat. Yeah, we're not suggesting that they've changed, to be clear. Yeah, thanks very much for that. Maybe another technical question. I'll stick with you, Anna-Rita. Matthias, you could join in. Which currency interest rate swaps need to be cleared from June 2023?
Well, the clearing obligation applies to interest rate derivatives denominated in a range of currencies, and I think we have for euro and US dollar and the pound and the Japan yen, and then I don't know if also others, but these for sure, I guess.
Yeah.
I don't know if Matthias have a greater,
Well, yeah, when you come in, Matthias, the reason why I want you to answer, it touches on a point Matti made earlier, where Pensions Europe had a sense that some plans are concerned about, they're obviously, have liabilities in lesser traded currencies.
Yeah, I think the clearing obligation is today applicable for a certain set of currencies. And my assumption would be that this is also then applicable to the pension funds, because the pension funds are just another client type within the clearing obligation, which were exempted, but the same products apply. I guess the other question is, if we speak about this rebalancing from UK into the EU, I think then we are pretty much speaking about euro swaps and Polish zloty, which were mentioned in the ESMA report and also in the communication from the EU Commission, which are on the one hand in the clearing obligation and on the other hand systemically relevant to the EU. So I think on this relocation topic, we're not touching on dollar swaps or sterling swaps. At least that is so far my understanding.
Okay. We're going to have one last question. We've run over time, but that's because there's so much to say. I think we'll have to come on and do another one. We'll have to do the sequel, everybody. If you can find time later in the year, or maybe after June next year, might be even more interesting. Jan-Mark, let's see if I can bring you in here. Please, if you can answer the question, say yes. Different clearinghouses are using different risk models, and most importantly, it ends up in different margin requirements. If we're trying to manage the same risk, why requirements are different for each clearinghouse? Should there be a regulation on margin requirements?
No, I don't think so. I think that every clearinghouse makes a deliberate decision on how to risk manage itself. There are standards and regulations that they need to stick to. That is also being tested by the regulator through fire drills and periodic tests that are being done. But I don't feel that there should be a standardized model that everybody should fit. I think it's also part of the competitive advantage of a clearinghouse to provide for a very good risk model that is efficient and has certain margin parameters in it. So it's a unique feature to a clearinghouse. But having said that, I'm also a big fan of having a choice of clearinghouses. I want both Eurex and LCH and others to be very active in European IRS trading so that I can risk manage between the clearinghouses and make my own choices on my split of 60-40, 50-50, or 40-60 as Matthias calls it. Having said that, the risk management of the clearinghouse is very important, and the argument that Matthias said on if there would be a better liquidity management feature in one or another clearinghouse, that would be definitely for us a reason to move part of our positions from one to another, and not because it's mandatory, but it's just a prudent investing for our pension funds to be at the best place in the best home.
Yeah,
that was a lengthy answer, but
that
I hope it answered it.
It was it was a super answer. Yeah, and the fascinating thing about all this is we keep talking about market-led solutions, and you kind of think, well, it is a bit chicken and egg. Would LCH or similar say there is money waiting for us? We simply need to relocate part of our business. It's not that hard. Or whether they say, no, we're going to stay here and we're going to see if the pension funds move, if the national regulators push them further to relocate. It's quite interesting about who reacts first. Matthias, let me ask you, well, maybe you have the final word, actually, on that last question. Do you need me to reread it, or are you okay?
No, I mean, I would close with some comments on what Jan-Mark said. So why are margins? So margin requirement for a 10-year interest rate swap should be not materially different on one CCP over another CCP. And that we should not compete on margins on a single contract. That's clear. We are here for managing risks and making sure that we are stable. I think where CCP sophisticated margining comes in, if you, for example, offer offsets between euro interest rate swaps and a bond future or a BTP future, and or a repo transaction, and just look at this as one margin pool and consider the correlations and offsets within that subset of products, ideally all denominated in euro, to take out the currency risks. And I think that is where the competition comes in, where we start to integrate services. I alluded to the repo and the swaps world, and now if you generate cash on the repo side, you instantly can face that without transit risk into the cash variation margin flow on the swap side. And I think that is where CCP competition takes place. And I wouldn't see and expect that the same portfolio would have a materially different margin requirement on one CCP over another. That is the wrong way it should go. Very clearly, race to the bottom on the margining side is not what we want from a CCP perspective.
Yeah, I like that. Very good. Excellent, actually. Much more holistic answer. Super duper. Thank you very much. We've run out of time. I'm going to ask you very quickly one question as you say goodbye. And I'll start with Matti Leppala from Pensions Europe. Thank you for coming on, Matti. It's been a great webcast. It's available, folks, on IPE for the foreseeable future and on BrightTalk, our technology provider for the foreseeable future. I feel obliged to show the disclaimer for a bit. The audience can read that in 10 seconds flat. While I'll ask Matti, the topic was, centrally cleared derivatives, blessing in disguise. Quick yes or no answer.
Yes, and it's important. It's a very important issue, and we need good solutions, permanent solutions. And just wanted to say in the end that of course pension funds can use derivatives only for reducing risks and efficient portfolio management. So they cannot speculate with derivatives. And the fact of the matter is that at least the European Insurance and Occupational Pensions Authority, EIOPA, doesn't have statistics on derivatives that pension funds hold. And there's an ongoing consultation that ends on the 18th of July, where they plan to include in the reporting requirements of pension funds what derivatives they have. Yeah.
Very good point, actually. Very useful. Yes, when I, as a journalist, look at pension fund reports, I see a lot of cash. I can't work out the actual economic exposure. Anna-Rita, I don't know if she's disappeared forever. I wanted to ask her quickly if she thought centrally cleared derivatives were a blessing in disguise. I would have thought they're a blessing, actually. I can't believe the European Commission.
Yeah, no, of course. As a regulator, I would think that it's a blessing.
Who invented it? Yeah, of course. Just checking you are with us, Anna-Rita. Thank you very much for your contribution from the European Commission.
Sorry, because I have an issue with the connection, so that's why I switched off the camera. So
okay. Thank you, Anna-Rita. Yeah, Mark Van Mil, centrally cleared, blessing in disguise.
It's reality, and we have to do it.
Excellent. I like that. Very sober. Thank you very much, Jan, Mark. And finally, last word to Matthias Karlich from Eurex.
Well, I mean, we're not solving all the problems of the world with central clearing, but I think it's a very, very good tool to manage risks and to make this whole marketplace safer and more resilient and robust. And that's why I think it's more a blessing.
I love that. I like that. Yeah, nicely put, Matthias. Thank you very much. Thank you very much to Eurex for sponsoring. I am just very briefly going to bring up here, this was the more important slide, because if you want to know further, there's some great attachments from Eurex that you can download, or you can contact this email address, fixedincome.sales@eurex.com. Someone there will be welcome to discuss the issue further with you. You've got another 12 months, basically, if you're listening from a pension plan, to sort out your centrally cleared derivatives. Good luck with that. This is Brendan Mayton for IPE, wishing all of our viewers a very good day.